Well, a merger of HDFC Bank and HDFC Limited will be done in July of 2023. On the lending side, after excluding the intra-company lending that they have, advances are expected to reach about 22.2 lakh crore, representing a growth of nearly 39% from the FY23 loan book of HDFC Bank. This places HDFC Bank far ahead of ICICI Bank, whose loans are at rupees 10.2 lakh crore as of FY23, but a bit behind SBI, which has its loan book at around rupees 32 lakh crore as of FY23. Deposits are projected to grow by 8.1% to about 18.8 lakh crore. The net interest margin picture. So HDFC Bank currently has a better net interest margin compared to HDFC Limited. However, with access to lower cost of funds, it can be expected that HDFC Bank's NIM will see benefit from HDFC Limited as well. Now, operational efficiency will take place post the merger. The cost to income ratio of the merged entity will be about 35.2% for FY23. This compares to 40.4% that HDFC Bank has seen for FY23. Talking about return on asset, both HDFC Bank and HDFC Limited have a quarterly ROA of over 2%. So the merger is expected to be accretive in terms of ROA. Talking about reserves, reserves are anticipated to increase by approximately 48% to about rupees 4.1 lakh crore. Thence, the bank may not require additional capital in the medium to long term on equity. So, equity increase, if you take into account the swap ratio and exclude HDFC Limited holdings in the bank about 20.9%, the equity of HDFC Bank is projected to increase by 34.3%. Post the merger, take into account HDFC Limited's 20.9% holding in the bank, including the ADR portion that they have. So, asset quality and risk. Gross NPA or the gross NPA ratio is expected to rise by about 49.7% to a little under 26,800 crore, while net non-performing asset or net NPA are projected to increase by 96% to about 8,561 crore. Post-merger, gross NPA ratio is estimated to be around 1.16%, which compares to 1.12% that HDFC Bank reported in FY23, and net NPA ratio is projected to be around 0.37%, up from 0.27% that HDFC Bank has seen in FY23. Provision coverage ratio may decline to about 68.3% versus the current 75.8% that HDFC Bank. Let's take a look at the risk weight assets to loans, which is expected to decrease to about 92.8% from the current level of 99.1%. The restructured book is projected to increase to about 0.42% from the current level of 0.31% that HDFC Bank. On branches and employees, the number of branches is set to increase by 6.7% to about 8,344, and the employee base is expected to grow by 2.4% to about 1,74,000 odd crores. So get ready for the behemoth in the financial sector, and private bank leadership for HDFC Bank will be far away from the competition and the reach of next competitor as well in the private banking sector. Back to you.